Good day, everyone. My name is David Williams, Executive Director of the United States Association for Energy Economics. It gives me great pleasure to welcome you to today's virtual case competition program. We are grateful to our moderator and chair for the case competition, Dr. Erin Mayfield from Princeton University, and our case competition student teams and distinguished judges for today's competition. We are also grateful to the King Abdullah Petroleum Studies and Research Center, KAPSARC, for their long-standing knowledge support of this important USAEE program. First, a little bit about the United States Association for Energy Economics. We are the largest affiliate of the International Association for Energy Economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find on our website at www.usaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our students, please click the Q&A button at the bottom of your Zoom window and type your question. And now I'd like to introduce you to our moderator, Dr. Erin Mayfield, postdoctoral scholar at Princeton University. Erin, over to you.
Thanks, Dave. This is our first year doing a virtual version of the case competition. We've done it in several years past during the annual meeting. This year we decided to host it virtually, given that the meeting is not happening this year. We want to also acknowledge all the USAEE administration that helped with this, and to reiterate Dave's acknowledgement of our knowledge sponsor. I also like to acknowledge one of the case competition co-authors, Professor Rebecca Ches at Purdue University, and also our judges who judged the report of all the teams that submitted this year. This year we had over 20 teams register, and 5 teams ultimately submitted final reports, and from that 2 teams were selected to present today. So this year's case competition, the theme was about blue and green hydrogen systems, and the client, which is fictitious, was Airgas Corporation, the 3rd largest supplier of industrial gases in the world that produces and supplies industrial gases and provides related services to the oil and gas, refining, chemical, healthcare, and metal and material processing industries. So this year's the client's request was to analyze to understand whether and how to expand into Spain, Italy, Portugal, and France to meet growing demand for industrial feedstocks used in these industries. The students were given a large, messy client request, very consistent with a real-world request of many different asks, and also many different things that were actually not relevant. It required the teams to distill the information, search for outside information, better refine the questions and answer them. So the main questions that the students were to answer this year were, what is the future industrial hydrogen feedstock demand in each of these countries, and how will this potential climate regulations or goals influence demand projections? What are the levelized costs of producing gray, blue, and green hydrogen systems in each country over time, and how will these estimates be impacted by uncertainty and variability and correlations between cost, efficiency, prices, system integration cost, and use demand applications, and other different drivers. Third, they were to develop hydrogen investment portfolios for each country under uncertainty and develop different strategies for Airgas corporations. Fourth, they were to consider the carbon dioxide emissions of different hydrogen investments. What are the climate benefits or costs associated with each of these portfolios, and how carbon tax or other regulations would influence investment decisions. Finally, they were asked to provide visualizations that help communicate relative findings of these analyses to both community stakeholders and potential industrial clients. So just to provide an overview of the format of today's case competition, each team will have 15 minutes to present, and I will give each team a 2-minute warning and strictly cut them off at 15 minutes, followed by 15 minutes of questioning from the judges and audience. Each judge will get the opportunity to ask a single question first, and if there's remaining time within the last 15 minutes, they will be able to ask more questions. Audience members are also permitted to ask questions after the judges get the chance to. Please use the Q&A function at the bottom of the Zoom call. The judging criteria today are based on responsiveness to the client's needs, the quality of the analysis, originality and insight, and the presentation quality. So today, they will solely be judged on their presentation and not their report. So the final two teams are, the first team up is Urbana Consultants, followed by Team Cardinal. And so without further ado, I will hand it off to team number 1, and I will start the timer once you're ready.
Sure, I'll share my screen real quick. Cool. All right, we're ready.
Okay, great. You can start whenever.
Good morning, everyone. We're the Urbana Consultants, and we'll be presenting hydrogen investment portfolio and the impact of climate policies. Thank you to USAEE for hosting this event, and for the judges for taking the time to review our papers, especially during this time. To assist their expansion plans into novel European countries, Airgas Corporation has hired a consulting team to offer investment recommendations. In this presentation, we aim to explain the rationale behind our investment decisions and to analyze the factors used in this rationale. We began by using 3 unique models to model the hydrogen feedstock demand in each country of France, Italy, Spain, and Portugal, with the objective of assessing whether there truly is growth potential in these markets. From here, we calculated levelized cost for 3 different production technologies to have a sense of the cost aspect. Given these factors, we are then able to analyze the existing and planned climate policies in each of our target countries and their level of accommodative infrastructure and other city-level factors. Naturally, this led to our investment portfolios of the 4 target countries, as well as an analysis of the climate impacts. To assess the potential growth of the hydrogen feedstock market in each of our target countries, we created 3 models to capture different growth drivers for this market. The direct feedstock model uses historical growth rates and analyst projections to project the market growth rate over the next 20 years, as shown in Figure 1. The industry breakdown model separates the feedstock market into different components, such as oil refining and ammonia production. The results for this model is shown in Figure 2. Lastly, the total hydrogen production model calculates how much hydrogen is produced for all uses, and then adjusts this total hydrogen to the hydrogen demand specifically for industrial hydrogen feedstock usage. Given these models, we created benchmark ranges for country feedstock market size. The projected market sizes in 2040 for our target countries is shown in Figure 3, where France has the largest market by a significant quantity. Perhaps more interestingly, the feedstock market in Portugal had the highest projected annual growth rate at about 3.4%, mostly due to ambitious climate policy of the Portuguese government and a growth premium caused by their currently smaller hydrogen feedstock market. Nevertheless, we saw significant growth potential in all our countries, with most annual growth rates between 2 to 3%. This market growth will act as a significant tailwind to the returns of our investment portfolio.
Levelized cost is a crucial energy measurement that is frequently used to compare different forms of energy. To calculate levelized cost of energy, we use the H2A hydrogen central production model from the National Renewable Energy Laboratory. We changed the reference year to be 2019 and updated some of the relevant input costs from the model's creation with relevant case studies, research, and recommendations by Airgas executives. The parameters in the model will alter to include 40% equity financing, a 3.7 interest rate on debt, and an inflation rate of 1.9%. For comparability purposes, we had the baseline output capacity of our three cost models be approximately 40,000 kilograms of hydrogen production per day. However, the gray and blue production plants benefit most from scale, so a scaling factor exponent of 0.6 was applied for any analysis of the impact of scaling. The results of our model indicate gray hydrogen has the lowest levelized cost of energy initially, while green hydrogen plants have the highest at 5.2 kilograms per hydrogen. In both gray and blue plants, there's a significant improvement in the cost efficiency of the technology at scale. Blue hydrogen improves 58.2%, while green hydrogen improves 19.9% in a mega-sized plant. Even though at scale, these plants may perform efficiently, the progressing efficiency of solar power may pose a threat. Based on future technological progress, if solar meets its 0.03 price target by 2030, the levelized cost of energy will be more competitive at $2.14. Although the production efficiency will remain lower than ethanol plants, the zero emissions component overshadows the downside along with the corresponding cost reduction associated with avoiding carbon taxes.
The EU is paving the path towards climate neutrality by 2050. First introduced as the Green Deal in 2019, this policy addresses three key targets: no net emissions of greenhouse gases, economic growth is decoupled from resource use, and no person nor place is left behind. With a holistic approach for climate regulation, all member countries of the EU are also a part of the EU emissions trading system, a market created to trade a capped amount of greenhouse gas emission allowances. Shifting into the national breakdown, since the establishment of the Energy and Climate Change Law of 2019, France has laid out clear standards for reaching carbon neutrality. There's a set focus on simultaneous growth of renewable energy as well as electric vehicles. France has even announced that they plan to eliminate the use of single plastics by 2020. Italy has had a long history of being pro-renewables and has excelled in integrating large volumes of variable renewable generation. From the 2013 National Energy Strategy, optimistic goals were set to reduce energy costs, scale alongside environmental targets, and foster sustainable economic growth. Spanish citizens have the right to receive a return on operation for high-efficiency, multi-generational facilities that use renewable fuels and natural gas. This will help Spain improve energy efficiency and reduce emissions in a large-scale production venues. There is an increasing level of urgency to establish an operation that will be sustainable and financially viable. The draft bill for the Sustainable Economy Law is a modern model for the Spanish economy. It is constructed around three central themes: improving the economic environment, promoting competitiveness, and developing sectors working in the fight against climate change. The law will better research and development processes by cutting tax percentages for innovative projects. And finally, Portugal has set ambitious targets for carbon neutrality. By 2030, the nation hopes to implement 80% renewable electricity and 100% neutrality by 2050. The National Energy Efficiency Action Plan encourages the use of electric vehicles, a massive decrease in fossil fuel consumption, and increases in electric charging stations. The 2008 version of the plan also incentivized energy-efficient companies, buildings, and schools.
Using these models, we were able to develop individualized hydrogen investment portfolios for each country and estimate their level of risk, as seen in Table 2. In France, we proposed that Airgas create blue hydrogen production plants soon and then transition to green hydrogen plants much closer to 2050. We believe that this is the best course of action based on the high demand in France, as well as the low costs of blue hydrogen production. We consider the investment in France to be low risk. The blue plant will cost $1.45 per kilogram of hydrogen, and this makes it relatively affordable. We also recommend that this be a large plant considering the high demand that is currently present, as well as the anticipated growth rate in France. France does have a high carbon tax of 44.6 euros per ton of CO2 emitted, which will impact the profitability of the blue plant, but we feel that is not enough to warrant a push to green yet due to the extremely high costs of green hydrogen. Blue hydrogen production is also very scalable, which will make this a better choice considering we are recommending a large plant. We anticipate that the cost of green hydrogen will start to decrease over time with future research in the industry. Due to the EU goal to reach zero net carbon by 2050, we feel that this plan in France allows for Airgas to gain market share and experience in the industry without spending too much money too early on green plants. Next, Italy, much like France, we propose that Airgas place a medium-sized blue hydrogen plant in Italy. We also believe that this is a low-risk investment. The Italian nation has a sizable demand and also has infrastructure. There are over 41,000 kilometers of pipelines within Italy, and Italy is able to incorporate the hydrogen into their current pipeline network. Italy is committed to following the EU plan of zero net carbon emissions, but is yet to make any form of carbon tax. This means that until a law is passed, no carbon tax to eat into the profits from the blue plant. It is likely that climate policy will begin to change in Italy as we get closer to 2050, but until then, we recommend that Airgas focus on blue hydrogen plants and take advantage of no carbon tax before spending a large amount of money to transition into green hydrogen later. This course of action will allow for Airgas, much like in France, to be able to gain market share and therefore move to hydrogen or green hydrogen later.
In Spain, we recommend a small-scale development of gray hydrogen plants to start. When looking at quantifiable data, it appears to be comparable to other countries in potential for development, and it certainly is not the least promising. However, external factors, including the attitudes of investors and the lack of development in hydrogen specifically, makes it so that we see moderate risk, despite the significant projected demand. There's very little information on the infrastructure in place that can support hydrogen to the scale projected as well. Spain also has one of the worst carbon taxes in a EU nation, with 97% of emissions not even taxed, making gray hydrogen a very appealing choice cost-wise. The attitude of EU nations as a whole is shifting towards going greener, so starting out with gray hydrogen develops long-term potential and will allow Airgas to establish themselves in the market there, while looking towards larger scale expansion and potential future development into either blue or green hydrogen. The few things to know about Portugal is their very low projected demand of hydrogen feedstock compared to the previous three countries, as well as their heavy use of renewable energy as a country, which is roughly 51% of total energy sector. For this reason, we recommend a moderate-sized alkaline electrolysis plant powered by solar PV to develop green hydrogen. Portugal's carbon tax is not very high, and the country has already developed a heavy emphasis on renewable energy. This subsidizes the cost of producing green hydrogen right off the bat. From a stakeholder's perspective, it is an economically feasible option that furthers the goal of zero net carbon emissions. However, we would also consider this as somewhat risky due to the higher than normal costs, the low projected demand, and the overall ambitious strategy.
Demand elasticity for carbon-intensive goods are highly sensitive to both time and geography. Most countries within the EU struggle to quantify the effectiveness of a carbon tax relative to the production of hydrogen. In many cases, there are numerous loopholes that prevent large corporations from paying the tax. The policies will only prove to be successful when they are considered a betterment to society and eventually become a societal norm. The global desire for respecting climate goals will assist prioritizing a decrease in carbon emissions and leveraging hydrogen energy.
With the objective of minimizing risk while sustaining high levels of return in our target countries, there are several general considerations for Airgas to reduce the risk of the investments. Firstly, energy and feedstock consumption is known to be highly correlated with general economic activity, creating a risk of economic downturns such as the current one caused by the COVID-19 pandemic. Nevertheless, we expect these to be very temporary due to the global push for clean energy and hydrogen, and that the gains from normal years will far outweigh any recessionary losses. Secondly, Airgas will be competing with established companies in each of our target countries, including Air Liquide in France and Hydrogenics in Italy. To offer time to build our near-term investments and establish ourselves in this new geography, we encourage Airgas to invest in locations that are typically underserved or in locations with particularly high growth rates. This should effectively minimize the competitive risks that we face in the near term and allow us to more effectively compete with established companies in the long term. And lastly, our investment faces the risk of technological stagnation in the energy sector, where the price of clean energy may not continue to fall. Nevertheless, due to the international push for carbon neutrality and the precedent of clean energy outperforming expectations, we do not foresee this being an issue. As we invest in the future, we feel much more comfortable betting on the success of science versus the contrary. We will now be opening the panel up for questions.
Okay, great. Thank you, guys. You're under your 15 minutes. Now, if judges, do you want to start asking questions? Again, one each, and then if there's time remaining, you can ask additional questions.
Sorry, I can't see the raise hand function. Can I go first?
Yep, go for it.
Yeah. Thanks for the presentation, by the way. It was really very well done. My question is, was the geographical analysis taken into consideration? The reason why I'm asking is because one of the recommendations was, I think it was for France and Italy, to go for blue hydrogen. And I was wondering if Italy and France have geological pore space to store carbon dioxide if they would install an SMR with a carbon capture and storage fitted with it. Was that taken into consideration of where would they store the carbon?
It wasn't a major consideration that we had in our investment because we were more looking at the demand prospects and the cost aspects of the investment, along with the national climate policy and the city level factors, such as the grid energy mix and the pipelines. However, we are fortunate that France and Italy are some of the larger countries in Europe, and so we feel fairly confident that they will have the space to store the carbon in the blue hydrogen production plant. Yep, go for it.
Yeah, well, thanks very much for that, Richard. I think it was a very good presentation, comprehensive. I think the issue is to kind of boil it down to what is the what should we say, the ultimate recommendation. And indeed, whilst France has got great potential, and you mentioned Air Liquide, of course, EDF and you know, incumbent in the nuclear sector, very, very powerful company. Spain, Iberdrola, one of the biggest companies in the world in electricity. I'm just wondering, is your recommendation really for sort of one shot, or is it perhaps diverse, you know, to enter somewhere as large as Europe with the various opportunities and everything, and particularly climate policies, which are a little diverse and etc. Really, should we go in one place, in one aspect, in one form of hydrogen, or perhaps, what you say, a diverse approach in what may be France and Spain, maybe Italy?
I believe we discussed earlier about having a multi-phase approach, because no single plant is going to be perfect at any given time. So what we plan on doing in the short term, some plants work a lot better. So that's why we want to implement gray plants initially to offset the cost. And then as time progresses and the cost goes down, it makes more sense to transition over to blue and green hydrogen. And in that multi-phasic approach, it really helps diversify and takes into account multiple factors and costs, and helps really make the transition as smooth as possible, rather than one big transition at one given point that could have a disastrous ending.
Yeah, it's like the age-old metaphor how when you're investing in a portfolio, you shouldn't put all your eggs in one basket. We feel that we would be much better to invest in different technologies in different locations throughout Europe, and whatever one seems most effective after this near term, then we can continue to focus our portfolio on that particular investment.
Okay, thank you.
Hi, this is Eric with KAPSARC. Great presentation. Thank you very much. The question that I had is, you've looked at only the demand for hydrogen in the target countries. If you had expanded the, so if you were only considering production in those countries, but then you wanted to consider hydrogen demand across Europe and with the possibility of exporting hydrogen outside of those countries, how do you think that your results would change, and what do you think some of the implications are for how to transport hydrogen across Europe?
Yep, so I can comment. So I would say to that, while we only chose 4 specific countries in Europe, we do feel like that they are representative of Europe as a whole, where if we look at these 4 countries as a sample of the European Union, that we get to see a very representative look of how the European Union's future in hydrogen demand will appear. And that's kind of where we derived that we expect about a 2 to 3% growth rate in our 4 target countries. I feel like it's fair to assume that we will see a 2 to 3% growth rate in much of the EU for hydrogen feedstock demand, which I guess impacts our forecast in a positive way because these are new markets that we can expand upon. Portuguese hydrogen is not limited to just Portuguese. It can be expanded across the EU, as you mentioned, and it can be traded across international borders. The reason why we chose to look at, like when we were looking at Spain, the reason why we chose to just look at the Spanish demand is because while Spanish hydrogen producers may trade with other countries, the climate impact they have is solely impacted by Spanish climate policy. So if there's a carbon tax in Spain, even if Spain buys it from Italy, it doesn't impact the Italian hydrogen producer. It's just based on the country where you produce the hydrogen.
And as far as the transportation of gas and hydrogen, we believe that there's going to be, it'll take each country to expand its network of gas lines and pipe network. Will have a high initial cost, but once that cost has been, the cost to maintain is pretty minimal and will be much more affordable, and the ROI on that investment will be high because the demand of hydrogen energy will continue to go up 2 to 3% over the next couple of decades.
Can I go ahead and ask the question now, Erin?
Yes, please go.
Yeah, actually, I think it may have been partly covered, but I'm still a bit confused. So I think it's more clarification. Does the analysis, if I understand, assume that the hydrogen is consumed in the country, is produced in the same country? But as I saw there was a discussion afterwards, which basically means that, economies of scale. Basically, I also have, if I understand the figure 2 correctly, you only looked at demand for industrial use of hydrogen, not in the transport sector or for storage in the power sector. And what is discussed in Europe mostly is the use of hydrogen where it's hard to decarbonize. So some industry, but also transport. So I wonder how the result would change, because of course, one of the key questions in hydrogen is where you produce, like central production, especially for green hydrogen, because you produce where you have cheap renewables, and then transport, and the other question is blending. And so those two questions would depend the analysis, because you seem to be assuming you produce where you consume. So I just wanted to clarify that.
Yep. So I guess I can address your second question. Air Gas Corporation was specifically interested in the industrial hydrogen feedstock usage, so that's why we chose to focus on that small component of demand, of the hydrogen demand. However, I would agree that yes, as a hydrogen producer, it is very important for what the transportation sector demands for your hydrogen and what potential uses for energy hydrogen can be used at the moment. So I would agree that for the long-term analysis of our products, for a more complete evaluation, we should include a consideration of how the demand component of all these different aspects of hydrogen will increase or be impacted by future technology.
And during our research, we realized that there's going to be considerable increase in demand from the regular population of like these countries in the EU, and therefore we expect demand to increase at just an equal pace as the industrial side, if not faster.
Okay, we have about 7 more minutes remaining of questioning. So if you want to ask additional questions, please go ahead. And also audience members, you can use the Q&A function to ask questions and we can relay them to the student team.
Well, I'll ask a question. Even though I was not completely clear, I'm sorry, in the description of the case, whether he was requested to look at on the industry, it says the client. And as having been a consultant most of my life, first thing you do is you question what the client asks you. So, I mean, first thing, because in the end, there would be only one hydrogen market. So my question is, does it make nowadays, where everybody's coming up with a very ambitious hydrogen strategy, not just the European Union recently with the strategy, but all countries, is it possible? What is the correct segmentation of the market? And can anyone position itself? If I see all of the industrial gases companies, they're trying to position themselves everywhere on the production side and the demand side. So you think it's possible to be limited to one segment of demand and to only one type of production? I don't think it came out completely clearly in your portfolio analysis. I've puzzled everybody here is my question, sorry.
Yeah, no, I certainly think it's possible to focus on just one part of the hydrogen demand, but I don't think it's profitable or intelligent to do that. I feel like if you're a hydrogen producer, you would want to expand your market as much as possible. And I feel like that is something that the Air Gas executives should highly consider. Just for the nature of the case study, we were told to only focus on the industrial component, but yes, and to be fair to them, currently virtually all of hydrogen demand is for industrial feedstock. But I would say yes, as the future comes and hydrogen energy becomes important and hydrogen use in the transportation sector becomes important, it would be very smart of them, and there's a large profit incentive for them to expand their market in any way that their products can be used.
Okay, can I just come in with another one? One of the, I think one of the final sort of issues that we're interested in is the communications to stakeholders, and particularly industrial stakeholders. And what approach do you think really is the most compelling? I mean, rather than just bland statements. I mean, for example, climate credentials of hydrogen, or the the costs of production, the trend, the foreseeable costs, or once again the potential possibly for big profits. I mean, what's the main, what's the real punchline for the stakeholders, the industrial stakeholders? Why should they work with us and what's in it for them as ultimately our clients.
To answer that, I think globally, as we're becoming a more green society, just as a whole, a lot of these corporations will want to implement some sort of like renewable resources into their day-to-day productions. And as this becomes just a societal norm, it'll help with just having a nice view of the company, but also promoting renewable resources.
Going off what my colleague said, as time goes on, the effects of climate change are only going to accumulate and get worse. And considering if other countries do not take their part and don't act against it, the demand for more clean and renewable energy is only going to skyrocket based off of the effects of climate change and how other countries react or not react and act accordingly. So our investors will obviously, the main punchline for them would be the fact that as demand increases and as climate change accumulates, the need for hydrogen energy will only increase, therefore increasing their profits and so forth.
Yeah.
Are there any other questions? We have time for maybe one or two more.
Hi. In your demand production, as I understood it, you did largely a kind of a top-down demand growth projection. Did you then do any sort of reality checks based on kind of a bottom-up look at, you know, the kinds of applications and demands you would expect for hydrogen, to make sure that your kind of top-down projection, you know, was in the, you know, a reasonable ballpark estimate?
Yeah, so to that fact, we made 3 separate models to model the hydrogen demand component for our estimates. And so the first model, the directly measuring hydrogen model, it was a top-down approach where we projected a market growth rate, and based on historical growth rates and market and analyst projections, which I would say act in somewhat of a sense as a fact check. But also we created an industry breakdown approach where we split the hydrogen demand into the 3 biggest components of the demand, almost the 3 applications of the demand sector for hydrogen. And we projected growth rates for those 3 separate industries. And I would say just the fact that we had all these models estimate very similar amounts almost acted as our reality check that our estimates are fairly accurate. And to add on top of that, I almost feel that our estimates are conservative in the sense that we only feel that hydrogen demand is going to increase by 2 to 3% over the next 20 years. And I feel like with the international push for clean energy and the potential that hydrogen has as a form of clean energy, I would not be surprised if that demand spiked in the last 10 years where technology progresses to the point where hydrogen becomes profitable, more profitable than it is now, but profitable compared to other forms of energy, and much more cost effective.
Great, thank you. So that concludes the questioning session. The other team should be logging on momentarily, so we'll wait a minute or two for them to log on. So thank you for presenting and answering all the team's questions or all the judges' questions. So we'll just hold on for a minute or two for the other team to log on. Good morning. So Team Cardinal, are all of your teammates accounted for and online?
Yes.
Okay. Great. So we have our 4 judges here, and so I will give you a 2-minute warning over the chat function. So you have 15 minutes to present, followed by 15 minutes of questioning from first the judges and then the broader audience. The first team, please do not ask questions. So without further ado, if the second team, if you want to share your screen, and I will start the timer once you're set up.
Can you see that?
Yes.
Okay. Are people seeing the presentation still?
Yes, we see full screen version.
Excellent. Should I get started?
Yes, you may start.
Great. Hi, everyone. Thank you for being here. Today, I'm going to be presenting on behalf of Team Cardinal Energy Consulting, and I am going to talk about our key findings for France, Spain, Italy, and Portugal's emerging hydrogen economy. To start off, I wanted to first present the key takeaways and recommendations at a very high level before we dive into the nitty-gritty of how we got to these. So in terms of countries, Italy and France look the most promising for hydrogen investments, both in the near as well as long term. This is driven in part by the largest market size in these countries, as well as the fact that the end users in these countries are the most diverse, and they include industry, transport, as well as buildings. Moving on to the next 2 countries, Portugal and Spain may become more attractive in the medium to long term, although in our analysis, they were not as appealing in the near term. The magnitude of hydrogen demand in these countries is relatively small, and the end-use applications seem to be more limited. Next, among the 3 technology options that we analyzed, which included gray, blue, as well as green hydrogen, again, the details of which we'll go into, blue seems to be dominated by gray and green hydrogen in each country. The shift between gray and green hydrogen occurs due to stronger climate policy, as well as declining costs of green hydrogen. Lastly, industrial end users, we think, are the safest investment opportunity. The key reason for this is that there aren't alternatives for industrial decarbonization right now, and industrial end users tend to be harder to electrify. And even if industrial decarbonization were to occur, that would happen at a longer time scale and not in the near to medium term, which means that gray hydrogen investments in these industries will not be displaced, at least in the near term. At the same time, we wanted to make sure that the clients were aware of what are some of the key developments that could move the market. What are some of the things that they should look out for? The first one is evolution of hydrogen costs for these different technologies, as well as the global policy landscape and the pace at which it's emerging. So if green hydrogen costs end up declining faster than we are projecting or testing, this could result in gray hydrogen assets that the client invests in the near term being stranded in the longer term. The same phenomenon could occur if more stringent climate policy materialized sooner and resulted in green hydrogen becoming more favorable earlier. And lastly, if global climate damages are accounted into national climate decision making and countries don't focus just on climate damages within their own borders, there'll be a stronger case for green hydrogen again. A second trend to look out for is the viability of electrification as a competing decarbonization strategy. So I alluded to this in the previous slide, but essentially some hydrogen end users can be electrified in order to decarbonize them, and the viability of electrification will determine which hydrogen end users are safer investments. Third, governments as well as private sector investments will be able to signal to our clients about longer term trends. And so if there is a huge influx of both government and private sector investment in infrastructure and network build-outs for hydrogen in these countries, that's a good sign. That suggests that the hydrogen market will be strong in the longer term. And lastly, the clients should also look out for potential synergies with negative emissions technologies that hydrogen could offer. One of these could be that because electricity is a large part of green hydrogen costs, having cheap electricity enabled by negative emissions technologies offsetting the emissions could result in lower green hydrogen costs. At the same time, they could also make viable gray and blue hydrogen costs by helping offset the residual emissions associated with that hydrogen. Now I'll dive into some of the details of why we are seeing what we are seeing. So starting with Italy and France, as I mentioned, Italy and France have robust hydrogen market demand. On the left, I'm showing you a chart which shows the potential hydrogen end use magnitudes. And I'd like you to focus on 2050, which is the last bar there. So two things that I would like you to focus on are green, which is the transportation, and gold, which is the buildings, seem to have a large demand in Italy. Second, industry demand is non-trivial. And so this emphasizes the point that there is diversity of end-use applications and a huge market. Moving to France, you see a similar pattern where the gray, the top bars, which are showing industry demand, the gold, which is showing buildings demand, as well as transportation. There's significant variation in end users as well as the magnitude is high, suggesting a strong market and a diverse market. And this data has been derived using the national plans, policy landscape, as well as international documents that talk about the hydrogen potential in these markets. Portugal and Spain have important but more limited hydrogen applications, as I alluded to. In Portugal, we only expect 5% of final energy consumption to be served with hydrogen. Although in near term, there might be some opportunities for post-COVID economic recovery packages that are incentivizing hydrogen. And lastly, Spain, the hydrogen emphasis seems to be focused mostly on the transportation sector. Again, not a big market and hence also not diverse in its end users. To summarize, France and Italy are expected to lead in total hydrogen demand, and Portugal and Spain, which are the red and yellow lines, in the near term, we do not see a very robust demand. Now I'd like to hand it over to Fola, my colleague, to walk us through some of the other input and modeling assumptions.
Hello. We now present a life cycle assessment of the 3 hydrogen production technologies. The cradle-to-grave equivalent carbon dioxide emissions analysis for gray hydrogen produced by steam methane reforming, or SMR, blue hydrogen produced by coupling SMR with 90% CO2 capture with monoethanolamine solvent and storage, and green hydrogen produced by alkaline electrolysis supplied by 50% wind and 50% solar photovoltaic energy. The system boundary for each factors in both direct emissions from the hydrogen production process, as well as construction, decommissioning, embedded emissions, and materials and energy inputs to account for total life cycle emissions. Next slide, please. The emissions intensity of each technology will influence the investment portfolio outcome, depending on climate targets. The plots atop present equivalent carbon emissions per kilogram hydrogen gas for each technology for the total system boundary on the left and directly from the hydrogen production process on the right. We perform uncertainty analysis on each technology to assess the spread. For SMR or gray hydrogen, the upper bound emissions intensity is obtained from the limit of a small plant producing 2,500 short tons of hydrogen a day, while the lower bound is obtained by assuming the methane fugitive emissions from this plant, as well as emissions from fuel combustion for steam production, are negligible. For SMR plus CCS or blue hydrogen, we vary capture rates from 80% in the upper bound to 90% in the lower bound. While for green hydrogen, we assume solar PV contribution of 100% with 0% wind energy in the upper bound and a solar contribution of 0% with 100% wind energy in the lower bound. Next slide, please. The design of climate policy in each country drives the demand and consequently the investment landscape for hydrogen. A premium on equivalent carbon emissions may be placed through a social cost of carbon, or SCC, in two ways. One is by considering local climate damages within each country, as in the national emphasis scenario on the left. Here, France is seen to have the highest SCC, while Portugal has the lowest. This scenario could also emerge if negative emissions technologies or other breakthrough technologies become available at a large scale, and the economic appeal of these technologies reduce the need for a higher carbon price. The global coordinated action scenario assumes all four countries, along with the rest of the world, develop policy consistent with global climate damage accounting. Next slide, please. Then, in considering the evolution of hydrogen production costs, we assess current levelized cost of hydrogen, or LCOH, for each technology, as well as contributions of cost aspects, such as capital charges, fixed operation and maintenance costs, and fuel and electricity costs to the LCOH. The impact of these contributions affects locational costs, as well as uncertainty in cost forecasts, as we will get into briefly. The table on the right summarizes estimates of the current LCOH for each hydrogen production technology, with SMR or gray hydrogen costing least, SMR plus CCS or blue hydrogen including the cost of carbon abatement in the cost of SMR, and the current least cost cases of solar PV and wind electrolysis shown. The cost of green hydrogen is assumed to be the average of these two, assuming a 50-50 split of solar PV and wind energy in the electricity mix supplied to the electrolyzers. More than 60% of cost in gray hydrogen and indeed blue hydrogen are associated with variable fuel and electricity costs, as shown in the pie chart on the left, making their LCOH particularly sensitive to spot and delivery prices of natural gas used in the SMR processes. As for green hydrogen, electricity prices and even more so capital charges are significant, as shown in the pie chart on the right, thus making these technologies sensitive to grid mix, given the high variability of renewables, as well as electrolyzer load factors. Next slide, please. In addition, we consider technology learning rates and the impact of learning by doing on cost, assuming perfect global technology transfer. System losses, especially those associated with hydrogen delivery logistics, which could be up to 45%, also affect cost. Uncertainty in cost estimates are significant due to highly time and locationally variable uncertain inputs on cost, such as natural gas prices, as I earlier mentioned, and labor. Next slide, please. We use all the aforementioned considerations as input into a custom optimization model, which performs a cost minimization by an optimally acting agent to select an optimal portfolio for each country, using hydrogen demand projections, levelized costs for each technology, CO2 emissions from each technology, and national emphasis social cost projections as proxy for carbon price, all out to 2050, with assuming industrial discount rates, 2% for Italy and 7% for France, Spain, and Portugal. We assume an exponential growth rate in demand from 2020 to 2050, a 30-year project life for each capacity build, and use direct emissions in calculating social costs, with all amounts in 2019 US dollars. The least cost technology is chosen each year to meet hydrogen demand. Next slide, please. Of the output from our model, we show year-on-year total hydrogen investment by technology type, as in the bar graph on the right. Here we show results for France. And as with other countries, we see that the optimal technology switches from gray hydrogen to green hydrogen capacity in the case of France in 2028, even with the price on carbon. The line plot on the left shows the evolution of levelized cost of hydrogen. It's the least cost green hydrogen with 50% solar PV and 50% wind declining to reach the least cost technology position in 2028. The pie chart shows the net present value of investment into different hydrogen production technologies, with 18.1 billion going into gray hydrogen in the near term and 18.7 billion going into green hydrogen in the medium to long term out to 2050. Blue hydrogen is not chosen, as current forecasts of carbon abatement costs exceed the carbon price projections. Next slide, please. Literature depicts uncertainty in natural gas spot prices reaching plus or minus 30%, which we use to analyze uncertainty bounds for the next present value of investments in each country. Italy and France have the highest expected total investments in both green and gray hydrogen, as shown on the left. In the chart on the right, the bars show the net present value of total equivalent carbon emissions associated with the optimal portfolio in each country, while the red circles represent the associated net present value climate costs using the national social cost of each country. I'd like to draw your attention to the magnitude of emissions from the Portugal portfolio relative to the low climate cost it places on these emissions compared to, say, Italy or France. And then, next slide, please. In conclusion, we would like to reiterate key takeaways from our analysis. Hydrogen investments in Italy and France look the most promising. While less attractive in the near term, Spain and Portugal may become more attractive in the medium to long term for hydrogen investments. And of the three technology options assessed, blue hydrogen appears to be the least viable, as a shift from gray hydrogen in the near term to green hydrogen in the long term is seen in all four countries. Finally, industrial end uses might be the safest investment opportunity. And also we would like to emphasize the opportunity in the power sector to replace transmission, especially with more efficient supply chains. Thank you.
Okay, great, thank you. Now, judges, if you want to each ask one question.
Maybe I'll go first again. Thanks for the presentation. I thought it was really well done. I thought it was very interesting, the stranded asset issue that you brought up. And I've just looking at the economics alone, you're saying that the blue hydrogen is not viable. Do you also think that blue hydrogen has a stranded asset issue linked with it? That if someone builds a blue hydrogen plant in those four countries, that sooner or later that they might not be profitable, or to generate a return, that green hydrogen would compete directly with that? Or do you think they will complement each other?
So I can take this one. So based on our analysis, I think you are right that we are focusing on the economics. In the near term, what we see is, based on pure economics alone, if emissions are not a priority, then you'd want to choose gray over blue, because blue hydrogen still has more emissions than green hydrogen. Now, if you focus on emissions, green becomes more attractive. So I think you are right in saying that blue hydrogen assets will also have a chance of being stranded. And the reason that that might be is because blue hydrogen assets become economic in the medium term, which means if we look at the life of the asset, they might be expected to stay online through 2050. And by 2050, we are not so sure that that makes a lot of sense, having investment assets that, when the global targets are net zero for the world, that doesn't make a lot of sense unless, as we pointed out, there are breakthroughs in negative emissions technologies, in which case you could have gray as well as blue hydrogen and offset the emissions associated with them with negative emissions technologies. But again, if you are going to have cheap negative emissions technologies to offset those emissions, why not do it with gray? Why pay the extra to go to blue? At least that's what we find.
Hi, this is Eric with KAPSARC. So it seems that the learning rates that you used may be a significant driver in the cost reductions over time and ultimately your overall results. In your certain uncertainty analysis, did you look at varying learning rates? And then a follow-up question is, if I recall correctly, the learning rate for SMR was 11%, but SMR plus CCS is 4.5%. does that imply a negative learning rate for the CCS component?
That is a great question, thank you. So we obtained those learning rates from literature, and based on the literature available, we find that the learning rates vary vastly from country to country just because of the huge variability in natural gas prices, as well as the different scales of different projects available and the differences in other variable costs. And so it's really hard to nail it down to be certain about the learning rates, which is why we used the uncertainty bounds for natural gas prices, since that is the most significant cost factor within the learning rates and within the cost of those technologies. And we varied that in our analysis.
And just to jump on there and add, in the uncertainty analysis, we do not vary the discount rate. It is only the natural gas price, as Fola just mentioned.
Okay, can I come in here? It's John Holding. Just in the inquiry package, the very last piece of information, and indeed the last line, it's requested that you look into the opportunity for biogas. Of course, coming from landfill, this is a natural source of methane, not coming from fossil fuels, and it's a problem to be solved. And I just wonder, you've not mentioned it, but did you look into any opportunity for biogas as a feedstock?
I can take this one quickly. So we were toying around with the idea that the green hydrogen that we kind of model has this varied grid mix, and we particularly look into biogas and bioenergy. And we were also considering coupling it with bioenergy and combined CCS to play with multiple CCS components, look at cost projections. But I think what we realized was that in the medium term, at least till 2038, the break-even that is achieved through just pure wind and solar, that is 50% wind and 50% solar as the grid mixed input, was just so much more viable. And we weren't anyway picking green hydrogen until that moment. So we kind of, it was not, it felt in the in our results and in just basically the timeline of this transition that it wasn't a very crucial factor.
Okay.
And another point, I felt like it would have been super interesting if UK was one of the countries that we were studying, but especially with the existing electricity market in France and UK, that didn't, France and Portugal, that didn't quite seem to fit into the strategy.
Mm-hmm. Okay, good.
So I'll go next. Actually, first a clarification question. Do I understand that you assume that the hydrogen was produced in the country where it was consumed? And did you look at all, or is in your analysis, are there any economies of scale? And have you looked at the possibility of producing someplace to serve several markets, and looking at the transportation costs with the different means of transportation, including the blending with the gas network?
So I can take this one as well. I actually didn't catch the first part of the question very well, but I'll answer the second one first, and I'm sorry, but probably could repeat the first part. But for the second one, we have done a little bit of qualitative analysis on the transportation and distribution aspects, but the way we've been tackling these different market segments have been through the demand curves. So we're not showing our slides anymore, but initially in the buildings and the blended natural gas segments, we initially assumed that each country, and in fact, each country's hydrogen and climate plans have these certain percentages, that they are aspirational percentages by 2050, that they're targeting this amount of blended natural gas in their markets. So we haven't done a very closed up analysis on specifically the blended natural gas segments, but it is being tackled through our demand and learning rate projections. And the first question, I'm sorry, I didn't quite catch it.
I think I could jump in. From my understanding, you're asking about the impact of learning by doing and scale on cost. And we do factor those in through our cost projections. So we use gas power production technology as well as current CCS cost projections to make as a proxy for SMR and the SMR plus CCS technologies. And we also factor those and make those assumptions through our learning rates. And we get these information from both IRENA and the IPCC, and we factor those into our analysis.
And one last bit for transportation. We have discussions for each country in terms of how their existing natural gas pipelines, especially if there are importing natural gas from North Africa in the countries, could be used as the next step for hydrogen transportation. And for Spain, we look at hydrogen refueling stations, which are a lot more decentralized in their distribution and transportation.
Okay, we have about 5 more minutes left for questioning if the judges or the broader audience has additional questions.
So this is Eric at KAPSARC again. It seems that, it's a great presentation, by the way. It seems that you're really looking at kind of a national level investment in hydrogen, and whether it be blue or gray or green over time. But in terms of air gas, an individual company making an investment, it wasn't really clear to me what your recommendation would be for this one particular company, given this market analysis that you've done. So maybe you could just take a moment to maybe clarify exactly what you would recommend air gas as a company to invest in.
I think at a high level, you are right that we did focus on the national level trends, but part of that was identifying markets in these countries. And so for the company specifically, we would recommend looking at industrial end-use applications in Italy and France. And we suspect that gray hydrogen in the near term and green hydrogen in the medium to long term would be an attractive, relatively low risk investment relative to blue hydrogen. The specifics of where exactly within these countries would probably depend on some of the factors that we've touched on before, the existence of pipeline networks, whether or not current industrial end uses that the company is trying to get into are efficient or inefficient. And so we didn't get into site-specific analysis of that. But as a starting point, I think what we found was that Italy and France industrial end uses would be a good first step.
Any more questions? We have about 2 more minutes. Okay, if there's no more questions, we'll wrap up this session. The judges will confer offline and the students will be notified later in the day of the results. Thanks for everyone for participating. It was a tough problem in a short time and a messy problem consistent with the way you'll see a problem in the real world as if you pursue consulting or really any avenue. So thanks for your participation and great job to both teams.
Thank you.
Thank you.
Thank you so much.
Thank you.
Erin, and on behalf of USAEE, this is David Williams, Executive Director. Wish to thank Erin really very much, as well as our students, our student teams, our distinguished judges, and in particular to KAPSARC our knowledge supporter for this longstanding program with the association. We're very, very grateful. Looking forward to learning the outcomes. I certainly learned a lot on this, so I appreciate everyone's time. Thank you once again, and I officially close this webinar.